We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jonathan Mergott, precious metals analyst, president of Alchemy Financial, and also president and portfolio manager of the Mergott Foundation. Jonathan, thanks for joining me again today.
Tom, thanks for having me.
It's great to have you back. And as you pointed out on Twitter the other day, it's been 2.5 years since we chatted last, which blows my mind. And we were kind of touching on that before we started.
Yeah, it really does. Life comes at you fast, you know.
Absolutely. Well, it's good
older
to have you back.
And the years just keep coming, right?
Yeah. It's great to have you back. And I think, you know, we're going to kind of base a lot of our discussion today around a lot of what has changed and what you're seeing in the market and why you're maybe changing some of your views. You know, a lot of people on Twitter kind of accuse you of being constantly bearish, but it'll be interesting to see, let's say, the changes that you've seen in the market that you want to highlight. So why don't we start by talking a little bit about something that you wrote about recently, and that's, you know, being in a, let's say, a stealth bear market and what it looks like.
Yeah, I think that's an interesting point because if we're looking at the gold price specifically, it hasn't been that bad. We've held up there. There's been other aspects. We look at silver, not so much. Miners have gone down. The GDX itself is down 50% from highs. Junior miners and silver miners have been a lot worse. So on the one hand, it's kind of hard to look at that and say like this has been a bullish consolidation. But on the other hand, it's not really a bear market when you're constantly in a situation where we have high inflation, we have wars going on, we have bank failures, and gold is constantly getting a bid. It's had periods of weakness, but we're not falling apart here. So there's been a lot of aspects where it seems kind of like a stealth bear market. One of the things that we typically see in a bear market is that when you're looking at COT reports, large spec long positions start to curtail. They're not reaching the levels that we've seen in the past, which makes perfect sense. They're long positions. If you had a market that's making higher highs and higher lows, people are going to be more interested in it. It's going kind of sideways or breaking to new lows. Those positions start to decline, and that's typical of a bear market. People have pointed out Comex inventories are declining. Again, that's kind of typical of a bear market. Which really there's nothing more to that than business 101. You sell jackets, nobody's buying jacket B. Are you going to hold a ton of it in inventory? Are you going to discount price and order less next time around? If we look at times when there have been bull markets in gold and silver, Comex inventories have increased the entire time. They decrease when things are going down. It's kind of simple business-like. So there's sentiment is another one actually too. You typically see in bull markets, we don't see massively low sentiment levels where bulls drop to like 8% on like DSI, which we've seen time and time again, but we've also seen it on the other way. It's kind of going back and forth. Mm-hmm. There's no real clear direction here. So, you know, I don't think we can call this a bullish consolidation when you see what you've seen in silver and in miners. But at the same time, it certainly hasn't been nearly as bad as previous bear markets like 2013, thankfully.
So, Jonathan, when you're talking about, let's say, a breaking to a clear direction, how much of that do you think rides on the Fed and their path forward from here? Did you think that they would get rates this high at this point? And how does that matter to the gold price?
I wasn't at all expecting any specific number. I think it became really apparent. I mean, it wasn't that long ago when you think about it, where most of the analysts were expecting multiple cuts by this point in time, by the end of 2023. And it's been just constant revision of higher for longer, and no reason to cut whatsoever. It's like, yeah, this is what's going to happen. Mm-hmm. Also recognizing the fact that, like, Powell is not Janet Yellen. Powell is not Bernanke. He was the one that was advising that we taper in 2009, 10 quicker than we did, that we raise rates quicker than we did. For better or worse, he's been a lot more hawkish. So this is exactly what we should expect from him. At this point in time, we are seeing CPI and the Fed funds rate at kind of neutral. It's looking like they are done hiking. He's trying to say that there might be a hike or two down the line. That's very well possible. I think at the end of the day, he gets more of an effect by saying that. Mm-hmm. Talk is probably their most useful weapon. You know, like back in 2009, the idea of I've got this big bazooka of money is probably just as effective as actually using the big bazooka of money. So, you know, sitting there kind of threatening that we might still hike interest rates gets the job done as much as actually raising another quarter basis or 25 basis points here. Mm-hmm. So I think for all intents and purposes, they're done, which isn't a bad thing. It's certainly a tailwind for gold. But at the same time, I don't think that necessarily needs to be the reason why gold is going up. One interesting point that people have been, I think, tying a lot to correlations, and they work right up until the point where everybody's focused on them. I mean, for all of 2022 was the idea that whatever Dixie does, everything else does the opposite. Mm-hmm. Until the point where that got so ingrained. And now, has anybody cared about what Dixie is doing? Look at what gold has done for the last couple of months. It's been completely immaterial. Mm-hmm. The idea that gold and real rates correlate has completely diverged over the course of the last year. And so what the Fed's doing for it, perhaps at some point in time. Now, one reason I have been a long-term bull on gold over, you know, looking for over a period of 10, 20, 30 years going forward is $33 trillion in debt that is now at the highest interest rate that we've seen in 15 years. At some point in time, does that matter? And do things begin to change where that correlation that we've seen in the past doesn't matter anymore? It certainly has completely diverged. So is the fact that the Fed's going to cut interest rates, is that really what is driving gold here? And I don't really think it is. I think it's kind of immaterial. I think that there's all of these things are ultimately symptoms of fear and a loss of confidence, wars going on, continued sticky inflation, debt that is spiraling out of control. And these are really the bigger drivers for gold.
So, Jonathan, when we're talking about, you know, let's say drilling into actually understanding what's driving the gold price on a week-to-week or a day-to-day basis, let's talk a little bit about what happened over the previous weekend here. Of course, we're speaking here on Wednesday, December 6th. Over the weekend, you know, we did hit a new record high. We closed above 2,000 for, I believe, the first time as a monthly close. But let's talk a little bit about how you see those moments and what actually, to you, explains the movements back down from something that looks overheated at times.
It could be that. It could just be as simple as the idea that you've kind of run into a brick wall and there's no one left to buy that is interested in chasing prices higher. We saw this when a month ago in October, when gold kind of waterfall down $100, and then you look over at the COT reports and managed money was going net short gold and silver right at the low, just ran right to a brick wall. I was saying capitulation at the time because we were watching sentiment falling off a cliff before this happened. 2 weeks before it happened, DSI for gold was 17. The week before it happened, it was 12. And as we were collapsing, we got down to 8. I mean, that is the definition of capitulation, when they're just throwing in the towel and the momentum chasers are on the wrong side right at the low. Then what sparked next was a huge short covering rally. And you get to a point, though, where, I mean, that's great if you're a trader, you made a really quick, big profit here, but big money is not chasing price up. They are waiting for the weakness to come to them. You're not putting $10 million into gold that after it's already moved $200 in 2 weeks. You want to wait for weakness to come to you and start buying strategically, try not to move the market, and very deliberately with that. So what ends up happening is you have a couple of short-term traders that are putting bids in a little bit under the market that think that there's going to be a little bit more to the upside. And as you start to lose momentum, a lot of sell orders to take profit on that. And then what you end up with is a hot knife through butter when those bids are absorbed and there's nothing underneath. So this could, as we start running and getting way, I don't think we really were, based on past events, massively overextended here. We were overextended enough to the point I was taking profits right at the close on Friday, and watching how the market was trading on Friday, and it looked pretty clear that we were just going to melt the entire day as shorts were like throwing in the towel and close at the highs right at the close, which is exactly what we did, and ended up dumping our GDX calls right at the close there for an 80% profit. But at that point in time, it simply came down to the fact for me that it was like we're sentiment is hot enough, we're overextended enough to the point where it becomes, is it reasonable and probable that we've got significant gains further from here, or is it more reasonable and probable that we're going to start giving them back at this point? And it was more probable that we're going to give back our gains if we continue to hold on to them. So we took them. Like I said, I don't think we were massively overextended here, but we were overextended, and we do need to cool off a little bit now. But, you know, this is far from the end of the world. We got, we live in times of algos just trading things up. I mean, you had a bankrupt video game retailer that saw ridiculous price movement. And now I haven't seen the movie, but I know there's a movie out on it now. And at the end of the day, how meaningful is this price action in the market versus what's actually the fundamentals here? It's kind of just meaningless attempts to cash in on short-term profit. So I don't think that just because we had this quick reversal, like, yeah, it paints the chart kind of ugly. The fact that people have been coming in and buying gold pretty strongly all year, in a manner that is very, very different from what we've seen over the course of the last 2 years, that isn't suddenly changed just because we ran up pretty hard. Algos were having a field day, turned and pounded the living hell on a Sunday night, and we had a reversal. That doesn't suddenly make the reasons why people want to buy gold, their fears to protect their assets, suddenly, oh no, now I'm not interested anymore. No, so the short-term technicals, we have some cooling off, but it's far from just like destroyed everything here.
Well, you know, you bring up the idea of GameStop and how crazy and overheated things got after COVID, really. And that kind of brings up the point to me of how risky you think the general markets and general equities look here and why that is.
Here's the thing. I mean, number one, all we've watched happen, all I've seen happen throughout my entire career is that volatility has done nothing but increase. We see, I mean, in 2008, we had a 50%, 65, I think, percent drop in the market. It took about a year and a half from top to bottom. In 2020, we dropped 30% on the S&P 500 in 6 weeks. Like, this is just absolutely insane. And this is, you know, GDX was 50% in the same time frame. Margin calls just like real fast, obliterating everything. This is the kind of thing that you need to prepare for. You need to look at your portfolio and be like, you know, am I bulletproof here? And bulletproof means like, can you make, all you have to do is wait and you can make it through everything. If you're in leveraged ETFs, Nugget, Dust, they all blew up in COVID. When you get something that's 3 times leveraged and you get a move of 30% or more in a short period of time, you just kind of broke the space-time continuum there. So they just completely stopped functioning. That kind of stuff will blow you up. Options, that kind of stuff will blow you up. Margin, obviously, will blow you up. If you can just sit and wait and recover, which is what always happens. But we do have to recognize the risk that this will, if something is on the horizon, it'll take down everything. And we live in an environment of over leverage in which every single time over leverage blows up the entire world, we punish them by bailing them out and dropping interest rates to 0% to encourage them to do it again. So we have to assume that at any given point in time, somebody is about to pull a John Corzine and make a massive bet on Greek debt that they think is a riskless position because they bought credit default swaps, and then find out that they're going to pay 50 cents on the dollar, but that's not going to be considered a default, lose on both fronts, and blow up an entire clearinghouse. And God only knows what the ramifications of that could end up being. So this is just like the world we have to live in, where this is a constant risk and we have no idea what people are doing until it's too late. So the end of the day, just make sure that you can just sit back and wait and survive because you're not completely over leveraged when it happens.
I think a kind of an interesting place to go from here, Jonathan, is thinking about, let's say, the order of operations for big entities to protect themselves. You know, in times like this, where, as you mentioned, we're looking at wars in different places of the world, we're looking at increased volatility, we're looking at all of these different factors that are real headwinds for different parts of the market. How do big entities, you know, try to protect themselves with gold, and does that extend itself to silver and the miners as well?
To an extent. I mean, traditionally, what we see is during periods of time of economic weakness where the market is crashing, what we typically see is that gold is going up beforehand, before anybody realizes there's anything wrong. Like it did, you know, gold tripled before anybody knew that the entire financial system was about to suffer the biggest collapse since the Great Depression. Gold was significantly off of its lows in 2019 before anybody knew that there was a global pandemic around the corner. And before the Fed even realized, oh no, we need to start cutting interest rates in July 2019. So it's kind of interesting what we're doing now. Let's take that into consideration, that often gold has a tendency to do this, and we look back 6 months later and go, oh. But in terms of, you know, the classic thing is treasuries and cash, where people are going to flood their money into, and then gold ends up getting hit with margin calls when everything else collapses. Although it does catch a bid in all of these occasions because it's very attractive, because we know how How are we going to fix the next problem? The same way we fix the old problems. Cut interest rates to zero, resume quantitative easing, and print like crazy to get everything back on track. And that's great for gold. So we know the playbook here. And so does everybody else. And that's what makes gold look attractive. But at the same time, we're in a situation right now where gold doesn't have any counterparty risk. Gold is an asset with value that isn't tied to $33 trillion in debt. And that starts to look a lot more attractive. Now, from the standpoint of silver, whoever said silver is poor man's gold did the precious metal community an extreme disservice here, because it just isn't. Look at price action. We'd be at all-time highs right now with gold if it acted the same. At any given point in time, silver is caught up between following gold higher and moving significantly lower with economic sensitive things like copper and oil and other industrial commodities. It's a precious metal. It's a former monetary metal, and it's an industrial metal. Now, my thesis, and I think a lot of people's kind of investment thesis on silver, is the idea of, it can be summed up in that quote: gold is the money of kings, silver is the money of gentlemen, barter is the money of peasants, and debt is the money of slaves. When the kings go after gold, when Elon Musk and Jeff Bezos decide they want a small position in gold, and that's where silver begins to look attractive as the kind of the precious metal asset of the people. This is something that, I mean, you're the typical middle class everyday person. If you have $100 left over after paying your bills for the month, do you want to put that under your mattress for 20 months until you can afford 1 ounce of gold, or do you want to buy 4 ounces of silver right now? Mm-hmm. And what, in terms of silver as money, what can't you use silver for? You go to the grocery store, get groceries, about 6 ounces of silver, fill up your gas tank, 2 ounces of silver. A mortgage or rent payment is pretty much the only thing in which gold would be a better use for. So my thesis is that silver will one day be kind of re-looked at by the market as a monetary metal of the people, and will play some serious catch up. But at the same time, I live in reality and recognize the fact that that's a speculation, and that's not how the market is treating it today. And position myself accordingly. I'm not putting my wealth protection money into silver, because that's not what it's for. Mm-hmm. I'm speculating that will change. But yeah, if you're looking for that insurance policy, inflation hedge, wealth protection, that's gold, and it's not miners and it's not silver.
So what is the gold to silver ratio telling us right now as well, Jonathan? And do you think that targets of, let's say, 7-to-1 or 15-to-1 gold to silver ratio are, even possible in this day and age?
The thesis at Alchemy Financial is reasonable and probable. Possible? Obviously, we can't say there's a 0% possibility of, 2011, we saw 30-to-1 ratio. At 80-to-1 right now, that would be like a fantastic move. But it's unnecessary. Again, I wouldn't go speculating and say, I'm going to take all my gold and put it into silver because it's a better deal here. However, I could take a percentage based on my risk tolerance here and say, okay, I can take 10 ounces of gold, trade it in for 800 ounces of silver here, and at 60-to-1, go back and get my 10 ounces of gold and keep 200 ounces of silver for free. And that sounds terrific to me. And that's what, 20% outperformance of silver versus gold from here. And we're beginning to see signs. I had sent you a chart that that we finally could be seeing a breakdown in the gold to silver ratio that favors silver. And now might be the time to be getting a little bit more aggressive on that. And that's just perfectly fine. We don't need to have ridiculous targets here of 14, 7 to 1. That to me is a perfectly good target where you can benefit just simply by playing the metals against each other versus having to need some ridiculous low probability thing to happen in order to get a windfall. I mean, if that's kind of why you're investing, go buy Powerball tickets. I mean,
So, Jonathan, I was doing some reading on a couple different places, and it seems like you haven't really been bullish on the metals and miners for several years here. So, what do you think overall is changing? Is it the price action? Is it the sentiment? What is the, let's say, the overarching theme you think that is changing at this time and kind of changing your mind about that?
Yeah, there's a lot of things. Yeah, it's been pretty much since the last time we talked. Majority of that time have continued to be bearish, with the exception of a few periods in January 2022, which we caught a great rally in, but then we unwound after that exactly the same way we did in June 2021 that had me concerned to begin with, just waterfalling down. You'd see gold up $15 and GDX would open up 1.2%. Then as the day goes on, gold would slide a little bit and close the day still up $8, and GDX would be down 2.2%. Like, you could not rally to save your life. And this is just, I had summed it up essentially, this is just not how a bull market acts. Mm-hmm. From a very simplistic standpoint, you don't need to be an expert in gold or a technical analysis guru here to just look at how your portfolio has been over the course of 2023 and realize that this has been drastically different from what we've seen in 2022 and 2021. We are not waterfalling down and falling apart on the metals or the miners. One of the most important factors that I propose, and we're saying, like, if as this kind of stealth bear market, where does the bottom finally come? And you look historically at lows in gold, and they seem to occur at a price point in which costs of mining and the price of gold is at a point that's so razor thin that miners can barely make a profit. And that's exactly what happened in 2001. We got pretty close to that level as we crashed to $700 an ounce in 2008. We were really razor thin in 2016, pretty darn razor thin in 2018. We had some room in the crash in 2020 at $14.50 an ounce on gold, but at $12 silver, nobody was making money at $12 silver. That was really the canary in the coal mine there. So as gold tanks down to my expectation on this, because we know how gold trades, it can be very, very volatile, and we're experiencing very high inflation. So my thought process was gold could go down a couple of hundred and break support, which it was holding at the time at about 1680. Costs could go up about 100, and we could get that kind of razor thin area somewhere around, with costs moving up to the 1300 region and gold going down to the 1500 region, and seeing about 150 or so dollars an ounce in profit margins and hitting that razor thin level. Oddly enough, what we got was kind of the opposite. Costs went up significantly more, and gold went from holding 1680 down to 1600. And within a few months of gold hitting 1600, now all of the miners are coming in reporting drastically higher costs. in the $1,400 an ounce range. There's 6 miners that represent 20 million ounces a year, and the weighted average based on their production, their costs are $1,400 an ounce between the 6 of them.
Mhm.
Now, theoretically, if gold was $1,600 an ounce, they should have $200 an ounce profit margins, but watch how that actually will work out. We're already looking at some of the higher cost miners here that are reporting at 1,700 and saying we had a realized cost basically every quarter this year for gold at 1,900. And they're still missing estimates. They're still reporting losses. All-in sustaining cost isn't the best metric we have, but it's what we have. So the idea that it wasn't like a perfect, you're trying to kind of hit 2 moving targets with 1 bullet here. But in terms of the idea of that razor thin margins, I think we had it. We saw the gold price drop, and then immediately after we saw a point in time in which the miners' profit margins are completely razor thin here, which is what happens typically at lows. The market is acting completely differently. We saw that slice down to 1820 on gold. Miners did not fall apart on a drastic waterfall $100 move higher. Now, I realize there's also been a lot left to be desired. We then rocketed up $200, and GDX kind of went it went back to where it started. It's like it didn't fall apart. It's not moving massively higher either. But this is an improvement because last year, a year before, you get that kind of move in gold, these things would just absolutely fall apart, and we're not doing that anymore.
So is this kind of, displaying that feeling of nobody cares or believes these moves now? It's almost like the market is, or the appetite for miners are burnt out because of that, that price action in gold that nobody necessarily believes that it's going to be accelerating because of that, leveraged play that miners end up being to the gold price.
Absolutely, yeah, and what the problem is, as people have found out the hard way, is that miners are leveraged instruments. They go up and go down based on expansion of their profit margins on the product that they produce. And as people unfortunately found out, as cost rose and gold didn't do anything, that we started seeing profit margins get cut in half, and in turn, miners got cut in half. But it really does feel now, as I've been saying for years here, watch the miners, because they really do give clues on what the market's doing. And 9 times out of 10, when we see that kind of they're not acting right, watch out. Or when they start firming up or making reversals ahead of the metals is a good indication that we're at a bottom. So I wouldn't completely write it off that we're not seeing weakness in miners. They're just not performing to the upside. And I really do think that is, let's be careful, but I think that mostly is just nobody cares. They've acted like crap. Margins have been cut down to the point where gold is consolidating, and they're down 50% from highs. We're at the end of the year. There's tax loss selling that I'm sure is going on. We've bounced up a little bit, which I think is also kind of a great thing overall for sentiment. So people are sitting there, if they didn't do it before, now they're going, oh, great. Now I'm up 20% from lows. I get to sell and take my tax loss selling before the end of the year, but it's a little bit better than it was before, clawing a little bit of that money back. But please still get me out of these terrible investments, which is just a great place to be if you're bullish. But yeah, I really do think that this is mostly just nobody cares about miners. and it's going to be kind of I'll believe it when I see it sort of thing with this.
Mhm. So when we combine that, that attitude of nobody cares, nobody believes this move with the, the low volatility associated with the miners versus the price of the underlying metal, is this the setup that you have been waiting for?
In a lot of ways, like if I could have designed the perfect situation to get bullish in, it pretty much is exactly what we're looking at.
Mm-hmm.
So you've got a gold market that, when we ran up to 2100 on the back of Silicon Valley Bank failing, which everybody loves to remind me, I got bearish a little too early, got my face ripped off on that one. But did fine being on the right side at just about every other turn. We got a news-driven panic of bank failures that drove gold up to 2100 and then halted. I've seen this movie before. Bank failures, World War III. Like this is like the great news headlines that really drive buying. That then turns around and unwinds when that fear kind of subsides. But what did we end up seeing? We didn't drop to 1600. We came down to 1950 and then held for 4 months while sentiment slowly fell off a cliff and nobody cared. Mm-hmm. And then we got that capitulation move down to 1820 where DSI dropped to 8. We've seen capitulation waterfall down moves at 1050 an ounce in 2016. We saw capitulation waterfall down at 1180 an ounce in 2018. We saw incredibly bearish sentiment and kind of a capitulation in October last year at 1600. Now we're looking at it at 1820, within 12% of all-time highs, and nobody cares. And miners are still off of lows by really marginal amounts. And at the same time, they have razor thin profit margins that a even just halfway decent rally in the price of gold that breaks above all-time highs, and you're seeing miners that have $200-300 an ounce profit margins that could double or triple from here relatively easily. Now, what ends up happening in those situations? Well, let's look back to 2016 to 2018 when profit margins were razor thin and then went up very quickly and exponentially for miners. GDX in 2016 was up 175% in 9 months, but the higher cost miners did way better than that. You had Endeavor, First Majestic, Coeur d'Alene up 8-fold in 9 months. The best one on my list was Harmony Gold, though, from 50 cents to $5 in 9 months flat, because I think their cost at the time when gold was $10.50 an ounce was $1,300. Mm-hmm. So at $13.75, 9 months later, they swung from a huge loss to a very unexpected profit, and that's exactly what happened. So if we sit here in a situation where nobody cares about gold, we're just consolidating quietly right under all-time highs, miners with razor thin margins at cheap prices where nobody cares. Yeah, this is pretty much the ideal setup, if you ask me.
Mm-hmm. Well, I think that kind of goes to the point of really this knife cutting both ways. It has been cutting, let's say, a negative way against miners in this environment where gold, isn't really going anywhere, but costs keep going up and mm-hmm. margins are just getting compressed and compressed and compressed. And then once we do get, an actual move in the price of gold, then that, in a way, that leveraged bet of the miners really starts working for you instead of against you.
Yeah, and it starts working for you in a much better way than it would have. Like in 2020, if gold took consolidated for a little bit and took another leg higher with miners mining at $1,000 an ounce, and we had gone from 2,000 to 2,500, you would have gotten a 50% increase in profit margins and probably would have gotten a 50% increase in the stock price of those miners. Mm-hmm. When you're looking at miners with $200 an ounce profit margins here, that would be $600 an ounce at $2,400-$2,500 gold. Logically, if their company is going to be earning 3 times as much money as they were a few months ago, what do you think is going to happen to the stock price? And we've already have kind of seen it from 1,600 to 2,100. GDX was up about 60% from the October low. There was a few miners that were up 200%, 3 times that in the same time frame. And that was the exact reason why, because these were the higher cost miners that had much more leverage. So this is really, unfortunately, it took that cutting the wrong way and just brutal devastation, flushing everybody out in order to get to this point where you have stocks that went from $10 to $2. But now we have a situation where with relative ease, they could triple to $6. And that's a great place to be if you're buying now. It's not going to be so satisfying if you've been holding for the last 3 years, though.
Mm-hmm. Kind of the opportunity cost of the last 3 years has been brutal if you haven't really gone anywhere or gone down. But again, looking at the setup, I think that's in front of us makes a much more interesting story. I was going to turn a little bit to asking you about, let's say, different balances of test portfolios that you have done. How do you come to find something that works best from a balance perspective?
And that's pretty much exactly what I was going to say regarding opportunity cost here. So when we look at this and go, okay,
how do we actually apply it?
What was that?
How do we actually end up applying it?
Yeah, we had these expectations. And what ended up happening, we're down 50% on the miners. In the meantime, the S&P 500 has doubled. Oops. The boring investment, the idiot's investment who knows nothing about anything about economics and finance. I've said this all the time, especially with the Alchemy Financial Group, and I really cannot say this enough or loud enough. I know complete idiots, and they're millionaires. Millionaires. And they got that way because they listened to a complete idiot of a financial advisor who told them, put money in index funds every single month, and they did that and let it compound for 30 years. Do they have a helicopter and, a Ferrari? No, but their houses are paid for. They got money in the bank. They're doing just fine. Mm-hmm. All right, so gold, obviously we're attracted to it because it has killer gains when it moves. But when we look at it honestly, this is an asset that 80% of the time isn't really doing much. It's going sideways, it's going down. We own it for the 20% of the time when it's doing something spectacular. So if you have an asset that's only really doing something spectacular 20% of the time, should you have 80% of your money in it or 20% of your money in it? Another instance, if people had a big balance of index funds as a good chunk of their overall portfolio and investment portfolio here, the losses on your gold miners and silver miners over the course of the last 3 years would have drawn down the gains that you would have made overall, but they wouldn't have been crippling you. And that is really, at the end of the day, we are the biggest risk to ourselves. We're going to sit there and screw things up, tinker with things, put allocations that are too heavy into stocks that we shouldn't have. if you've got a bulletproof locomotive just going at 10% a year, that's, yes, very, very boring, but how many times do we got to prove over and over again that the average person on a long enough timeline never beats the S&P 500? If that's the situation you're in, you can sit there and afford to have relatively, you're not putting 30% of your money into one stock, but you have a position in something that you think is going to outperform. If you're right, you're adding to your gains. If you're wrong, you're not crippling yourself. You're up 7% this year as opposed to 10%, but you're not down 30%. So, within, as people I'm sure have figured out from experience over the last 3 years, being invested in junior miners has not really outperformed, and that hasn't been the case on pretty much any time frame from a buy and hold standpoint. So what has, having money in what works 80% of the time, but then sometimes doesn't when there's recessions, versus the other way around is the best place to bulletproof your portfolio. And then within the gold aspect of your portfolio, it should come as no surprise that when you're allocated more gold in terms of your physical holdings versus silver, you've done better. When you have more bullion in general versus mining stocks, you've done better. When you have more royalty companies versus producers or juniors, you've done better. Now, there are times when you want to shift that and get a little more aggressive in favor of higher cost miners and silver, which I think is that exact period of time. But overall, realize the fact that you can look at some of these 40-year charts on miners and just see 4 decades of destruction of shareholder value with periods of time of 3, 4, 5 bagger returns in between when you catch them right. This is very much a timing thing. You want to buy them, take your profits, and roll those profits into what has been worked as long-term investments, which has been bullion, royalty companies, and index funds. So I recognize the fact that everybody wants to sit there and go like, yeah, okay, I'm going to bet the farm and make a lot of money, and then I'll find religion and start, putting money into index funds, into bullion, but I'm going to leverage it all into junior miners that are going to get me 10 baggers. And, even now, this is a bad time to talk about this because, yes, it looks like you can be more aggressive and have that pay off. It's like, okay, you fall into the same trap. It's like, yeah, but afterwards, it's like, at some point in time, the time is now, and at the end of the day, if you bet the farm and you actually win, which is unlikely, what are you teaching yourself? That the low probability, high risk trade works and that you're the smartest guy in the room and you can do it again. And chances are you're not going to do it again. And then when that fails, it's going to hurt twice as much. So, the people that start out and they're disciplined and they have a conservative, well-balanced, bulletproof portfolio overall do well. And that's the lesson we keep learning time and time again.
How do different balances, actually, let's go back to talking about the actual balance. If we can put in kind of a number on it, Jonathan, are you just saying that we're waiting in boring instruments until the time that we see we want to kind of get more aggressive and in a way bet the farm? Or is it that, you're keeping an allocation of royalties and low cost producers for a decent amount of the time and getting aggressive with some dry powder at turning points like this?
It really depends on who you are. A lot of people do not want to, they want to buy and hold and set it and forget it. And if that's your mentality on it, then you want royalty companies that give you a little bit of leverage, and you want gold and silver bullion and leave it at that. It also depends on your risk tolerance. I work exclusively in the gold sector. I do not have 100% of my money in gold. That is not first of all, I just don't think that's a smart idea for anyone. And it doesn't fit my risk profile. And somebody else's might be completely different. Having 80% of your money in index funds and 20% in a gold portfolio, and then within that gold portfolio, having 30% of it in gold bullion and 20% in miners or royalty companies, it could be completely different for you. But I wouldn't. You start getting to like, I'm going to have half of my money in gold versus index funds, and we're going to stack it mostly towards producer companies where we have these periods of time where when costs rise and gold doesn't do anything, that knife cuts the way we don't want it to. Mm-hmm. That is not a good idea, but you can shift this balance. It really just has to do with your own personal risk tolerance. And this is something it's not easy. You got to get honest with yourself. Everybody can sit there and say, like, on paper, I can suffer through a 50% drawdown on junior miners. It's very different when you're actually experiencing it and you just watched half of your hard-earned money just vanish. Mm-hmm. That's when people make wrong emotional decisions at the wrong time. And the goal is to prevent yourself from being in that situation before it even happens. And then you're not going to make those emotional decisions. So you got to get honest with yourself, but there's no real like correct answer. There's an ideal balance, I think, that is somewhere in between in terms of overall investable assets, somewhere in between about 60 to 90%, depending on your risk profile of index funds versus gold. And then within gold, you can have 20% in gold, 10% in silver, and then start shifting a little bit to make it 15-15. Take royalty companies that could be 25-30% of the portfolio and begin shifting that so that that's in miners. The producers that have more leverage. Royalty companies are great and they'll do well, but because they have such low costs, as gold goes higher, they'll have leverage to gold and they'll do quite fine, but not as well as the miners that have much higher costs. Mm-hmm. But again, this isn't something where I just want to completely like sell all of your gold in favor of silver, sell all of your bullion in favor of miners, and bet the farm either way. This is just a shifting to a more aggressive stance so that eventually then you can take those profits and shift back into what has worked as long-term holds. And at the end of the day, the exact balance is really just personal preference on risk tolerance.
Mm-hmm. Well, and I think that risk tolerance also works differently for different people. I mean, you and I were kind of discussing the difference between somebody, let's say like Eric Sprott and your average Joe, and how you're able to actually allocate funds based on, having your house paid off, for example, right?
Yeah. And that's everybody. Like Eric Sprott is a very, very intelligent, very rich guy, and he's invested in junior miners. You want to do what the very intelligent rich guy is doing, obviously. But let's put some things in context. Eric Sprott's house is paid for. Eric Sprott, his kids' college funds are paid for. He's got, I'm sure, a few million in the bank as an emergency fund. He's got other diversified investments where if his junior miner stocks go belly up, he'll be just fine. Can you say that? Like, if you sit there and go, okay, I got $100,000 and I want to buy junior miners, and then realize, okay, maybe that, let's take the whole picture here of I want to be like Eric Sprott and not just he's invested in junior miners. Okay, well then if you're looking at it from that standpoint, maybe sit there and take like 30% of that and put it towards your mortgage. Take 20% and put it in the bank and make sure you have that emergency fund for things that could be unforeseen. Take a little bit of it and put it into that bulletproof kind of locomotive chugging along at 10% a year in diversified index fund investments so that you're not completely crippled. And now what are you left with that you can put in terms of into junior mining stocks? And then chances are actually you're in terms of a percentage allocation, your money is like 0.1% of Eric Sprott's, but in terms of percentage allocations, you're probably actually somewhat in line with that. So yeah, let's not focus on the one thing here and take the whole bigger picture into consideration.
Absolutely. I think that's an important point to consider, especially when things start to really get exciting, as we were talking about. Excellent, Jonathan. Well, kind of, I guess, in summary here or wrapping up, what do you feel like you need to see from this market to really confirm that this is a time that you are kind of changing this bearish stance that you have been seeing this market through?
Quite frankly, I think it's done a very good job of kind of proving itself this entire year. Like I said, you don't need to be a technical guru here to realize that your portfolio is not getting massacred the way it was the last few years. We're seeing reasonable pullbacks. Then we're seeing money come into these pullbacks. It's not waterfalls. The miners aren't absolutely collapsing. From a technical standpoint, we've seen gold pull back to the 200-day moving average and rally again. In general, a inclining 200-day moving average that we're staying mostly above, which is technically bullish. As long as we continue to see kind of a 2 steps forward, 1 step back. I'm going to get technical about 50% retracements, but we could keep it simple like that. Mm-hmm. Sort of action and price, and we see buyers coming in. We're not waterfalling down. Miners aren't absolutely collapsing. Then I think we are in a very good situation. We're a little overheated here. I think from a timing standpoint, this is perfect. We're at the beginning of December. We need to cool off. We got the holidays coming. Let's let everybody go Christmas shopping, finish up taking their tax losses on these things that they finally were up a little bit. Let me get out of them. Finally, go spend time with their families, get that period of time bulls in gold to kind of flush out here, and then see where we land in January, which is typically a very good time seasonally for gold. But my guess here is that is going to continue to be what we've seen, which is reasonable pullbacks that get quiet, that see buying come in, that ultimately lead us to a break of $2,100 an ounce. That puts us in a position where if we look at what is historically been, like I said, my thesis is reasonable and probable. Mm-hmm. We look at gold at breaking $1,000 an ounce, rallied up 20% in about 2 months after we did that to 1225. Just about every rally from 2009 to 2011 averaged 20%. That brings us to about 2,500. Mm-hmm. Silver's been kind of underperforming, but we know how that goes. When it catches up fast. That could be a total wild card, but I don't think we need to have unreasonable expectations here to make a lot of money. At $35 silver, which I think a lot of people might say is low compared to the highs at 30 that we hit if gold is 2,500. Consider the fact that some of the miners mining at $20 an ounce here that have $3-4 profit margins here would increase to $15 an ounce, and what that means for the stock prices. We don't need much more than this. Every few years, you get a situation like this where you have tremendous gains in the miners that come from that exponential increase in profit margins. And I've never been the one to sit there and talk about 10 baggers and ridiculous price objectives. but we know that this happens historically because we've seen 8-10-fold increases in miners in 2016, 5-6-fold increases from 2018 and 2020 to 2021. This is not unreasonable. This is not outlandish at all to expect that some of these could triple from their current levels. And just for an example here, in terms of that idea of like juicing up gains, so you had 175% gain in GDX from January 2016 to August 2016. Mm-hmm. Now, nobody bought the low and sold the top perfectly. That would have been tremendous. But let's assume for argument's sake that you did. You nailed it perfectly, booked 175% profit. Then you booked a flight, went to the beach, and didn't trade a single other stock for the next 7 years. You're still sitting on an annualized gain of 15% a year, just on that one alone, versus the S&P's 13.5% a year in the same time frame. So this is the type of thing where you catch it and make significant profits. You really juice yourself up for your portfolio's gains for the next 5 years or so. And that's what we've seen in the past. That's what I expect again. And that's, we only need them once every couple of years to catch something like this. And we're in a very good situation then.
Absolutely. Jonathan, let us know a little bit about more where we can find some of your writing and stuff. I know that's changed since the last time we spoke as well.
Yeah. So started the Alchemy Financial group at it's patreon.com/Alchemy Financial. A lot of the articles that I typically write are there. Some are accessible to the public. Some of them are exclusive to members of the site before they're accessible to the public. But yeah, I've been having a lot of fun with this. We got a spreadsheet of the gold stock database that has currently almost 100 producers and juniors, slew of fundamental data, technical data on all of them. The technical indicators that I'm looking at that I find significant to see if something is outperforming, underperforming, and all of that weighted into signals that show strong up, strong down, hold, that we can look and see who's outperforming versus their peers based on that data versus the indices like GDX. And when we're looking to target something in specific, we can sit there and go, which miners have better debt ratios than others, which ones, who is producing a lot of the silver companies now are silver in name only. When I want silver, I want silver. Mm-hmm. I don't want silver equivalent that's really 60% gold. I don't want gold that's 25% copper or silver that's 50% zinc. If I had a bullish thesis on commodities in general, that would be great, but zinc and copper are not money. And we can look for who has the most silver exposure there, who is mining for the highest costs, and target who stands to be the best performers. We got the portfolio management spreadsheet, which we were getting into in terms of what has worked over a period of 5 to 35 years in terms of balancing and index funds versus gold within the gold portfolio, gold versus silver, bullion versus miners and royalty companies, and what's worked. The best part, though, is the Discord server, which has been just fantastic. We've got where we have multiple rooms to talk about miners, precious metal direction, other opportunities we're seeing in the market. We caught a great opportunity in September to hedge our index fund accounts before that 10% correction, then shift profits right back into them right before things started turning higher in the S&P. We are discussing, we got a great group of people. We're sharing information from all corners of international world that we're from here. The the whole purpose is not being afraid to have the conversations of what if we're wrong? What does that look like? What if, we're going significantly lower here? Which is important to have. I'm not the smartest guy in the room. The moment I'm thinking that, the moment I'm about to make a mistake, as well as sharing, what I'm looking at, what I find significant on a day-to-day basis. But most importantly, exactly the trades that we're making, exactly when we're doing it, what instruments we're using, when we're buying it, and the exact prices they're at, where they are free to audit past results because it's the only thing that's posted in that room. And it's been a tremendous amount of fun. Like I said, we have a great group of people. We're having really good conversations, staying ahead of the curve and making money while we're doing it. So it's been a great time.
Excellent. And of course, that's available at patreon.com/Alchemy Financial. And you're still fairly active on Twitter as well, at jmergz, MERGZ 1985, right?
That is correct. Yep.
Excellent. Jonathan, thanks so much for your time today. It's great to catch up and to get your thoughts on this changing market. And hopefully next time we talk, we can, say we have captured some of those gains that we've been speaking about.
Yep. Hopefully. Tom, thank you for having me on. Happy holidays to you, to your family, everybody at Palisades. Happy holidays to all of the listeners. Yes, thanks again for having me on. And I promise we'll do this again sometime, and it won't be 2.5 years from now.
Absolutely. It's always a pleasure, Jonathan. Thanks so much.
Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.